Hello everybody, welcome to today's webinar, Organic versus Inorganic Means to Build Scale, Skills, and IP, with TBR Principal Analyst Ramunas Svarcas and Analyst Hristov. I'm Justin Surgent and I'll be hosting today's session. Insights from today's presentation are shared from TBR's Global Delivery Benchmark. If you'd like to learn more about this report, please reach out to myself or one of the analysts after the presentation. Now before we begin, there are a few housekeeping items I'd like to cover. First, I'll be recording today's session and posting it on our YouTube site, TBRI channel. We encourage you to visit this channel to watch this presentation or any of the previous presentations we've posted. Second, I'll be following up with all of you via email tomorrow afternoon with the link to the recording for today's presentation, as well as with the slides from today's presentation, so please be on the lookout for that. Finally, we welcome questions on the material we're presenting today. Please send any questions you have to the Q&A function, preferably not the chat function, as it's easier for us to sort through on our end. And we will answer as many as we can at the end of the webinar. So with that, I'd like to hand this over to Ramunas and Boz.
Thank you, Justin. So today we're going to be covering our Global Delivery Benchmark. This benchmark we publish on a semi-annual basis, covering 14 companies in the IT services industry. One of the questions we many times have is, why do we only cover 14 companies? Interesting enough, those 14 companies in our benchmark on an annual basis generate over $225 billion worth of revenues, accounting basically for over a quarter of the IT services revenue stream on an annual basis. Those same companies also employ over 8.5 million people. That's basically the equivalent of the size of the number of people in London or in New York City. So we really cover a wide variety and number of people and or a large revenue stream of the IT services market. And it reflects really what's happening because these are the leading companies in the marketplace and determine what's going on from a headcount standpoint. And with that, what are we going to actually cover today? Certainly we're going to provide a little bit of overview of what's happening in regards to headcount growth, what's driving it, and we're going to dive a little bit more deeply into acquisitions and how they're impacting the headcount growth. And finally, who's continuing to make money, is the way the headcount expanding or contracting positively or negatively impacting operating margins for the various vendors we have in the benchmark. So, what's actually happening? The upward trajectory in headcount growth continues. We're seeing a number of firms continuing to hire in spite of the fact that there's other firms that are laying off. The overall market really is showing that there's a trend in the marketplace that's showing that headcount still is a key element in the IT services spectrum. Services, by our definition, is basically what activities delivered by people. And that's why we focus on the headcount side of the equation. Certainly there's a lot of other things going on in the marketplace that are impacting the number of people that are delivering IT services, and we'll get into some of those aspects throughout the presentation. So, where do we stand today? This is a chart that basically adds up all the 14 vendors and reflects the revenue growth versus their headcount growth in regards to IT services. And the very end of the chart certainly suggests that, wow, we've got a little bit of problem. Overall revenue actually for the 14 firms has somewhat contracted, yet headcount growth continues to expand. What's driving this? We're definitely seeing that there are skill shortages, and the whole industry itself is changing. The advent of cloud computing has created a huge skills shortage in a number of different areas. Firms have to hire that, and the fact of the matter is they can't replace people that are still working on existing engagements in some of their old legacy contracts and so forth. What's interesting is when we add up the 14 firms here, as I'd mentioned, they account for $250 billion worth of revenue. The next slide shows a slightly different perspective. We removed 3 of the vendors from our IT services benchmark and wanted to see what actually was the impact. And this is a very interesting slide because it shows that the remaining 11 vendors actually are, for all intents and purposes, very closely aligning their headcount growth to their revenue growth. There are a few blips, a few changes in a couple of places, but it's a very close alignment. It certainly suggests that eventually, and in this last quarter for which we have the benchmark here for the second quarter of 2015, revenue growth actually for those 11 firms actually outpaced headcount growth. Now, of course, the big question is, which firms did you pull out? And if you can read the little note on the bottom, we basically removed HP, IBM, and CSC. The three firms have basically encountered significant revenue contraction, which really impacts the overall picture of the environment that we're looking at from a vendor perspective. So, we have certain firms that are moving in one direction and are having different impacts on the overall industry. Other firms are moving in a different direction and likewise are positively impacting the industry. Well, if you look at the next slide, this really gives a little bit more detailed picture. This is a very busy slide, so I'm going to explain it a little bit. The left-hand side of the slide really talks about our headcount in terms of total headcount for every one of the firms. And it's a comparison of, headcount at the end of 2Q14 versus the headcount at the end of 2Q15. The slide itself is partitioned into basically low cost as well as onshore headcount. So it gives you kind of a sense or feel for, firms and what kind of headcount they actually have and the composition of the headcount. The little graphs there, the little arrows and charts are indicating actually, the percentage of year-to-year growth in headcount. And the absolute number and the positioning, if you notice the zero line where you have some firms that are actually still contracting their headcount, and there are other firms that, are growing and expanding. If you look at the left-hand side of the chart, we really see, IBM there as well as a number of the traditional systems integrators that have had, strong support and maintenance and have been involved in the hardware play, are really all still contracting in terms of headcount. They're trying to address the marketplace. There certainly are, trying to rebalance their workforce and trying to figure out how, from a services perspective, to deliver services in a cost-effective manner with less people, because the type of people they need, they don't necessarily have. They're going to have to reskill them. They're going to have to do various things with them. Accenture shows pretty strong growth, 14.5% in headcount. The Accenture growth, while they certainly are hiring people, is in part also due to acquisitions. And we'll get into that a little bit later on in the discussion. On the tail end, the Indian-based vendors, they have historically always grown pretty dramatically from a revenue standpoint. They're likewise expanding their headcounts. HCL is approaching it from the direction of they're going to continue to hire and build headcount in India. Certainly there's some onshore activities and they are hiring some people in onshore locations, but still the majority of their expansion has been India-based. Conversely, Infosys is actually trying to build out locations and expand in the nearshore locations. They added actually, in their plans over the next 5 years to add over 500 people, say, in Poland. So they're definitely driving the nearshore approach in terms of their headcount expansion and their global delivery capabilities. So we're seeing that, there's a lot of different trends happening in the marketplace. They're having quite a varied impact on overall headcount growth. Some firms are starting to dig themselves out of reducing their headcount and starting to build new staffs. Others are dramatically, expanding. And one of the ways that firms are expanding is through acquisition. So with that, Boz, I'm going to let you take over the next section.
Sure. Thank you, Ramunas, and good afternoon, everyone. So really wanted to kind of look into, we kind of identify the trend of acquisitions being in the means for scaling up across scale and skills and IP. I mean, acquisitions is nothing new for the sake of the IT services industry, but we started looking a little bit closer when we started seeing some vendors pursuing like a string of pearls, like attacking acquisitions, like Accenture, or we saw some of the big announcements that Capgemini executed, like iGate, or Atos took over Xerox's ITO business, and we started looking at the broader range of the 14 vendors in the benchmark. I wanted to see what are the kind of the strategies of those vendors that are looking into, and how it impacts actually the overall headcount as part of the overall headcount. We want to see our acquisition really be as impactful as we thought, and we did some internal analysis to kind of see in our database to see the type of the scale the acquisitions are adding to the overall headcount. And as you can see, with the exception of Atos standing out, and that's just kind of give you a side note here. The Atos and Capgemini numbers, in the sense of the headcount from acquisitions as a percentage of total headcount, do not include iGate and Xerox's ITO businesses. Reason being is those businesses were, they came on board, they were acquired, and moved on to the ended operations of those companies as of July 1st, 2015. So that was kind of more the 3Q, the beginning of 3Q15, and the benchmark covers up to 2Q15. So I wanted to kind of delineate where the numbers are. So I want to look back from 2013 through 1H15, about 2.5 years. I want to kind of track and see who's doing what and why vendors are doing in the sense of the acquisitions and the strategy behind it. So a couple of examples. What we identify, for example, Accenture is really, as I mentioned earlier, getting after attacking small acquisitions, but it's building a vertical expertise and business-centric solutions. That's what acquisitions have been providing, more so than just number of people. Atos' acquisition approach is around filling the gaps with competitors in mature markets, and that was kind of reflected to the acquisition of Xerox's ITO in North America, where IBM is someone which kind of prioritizes their approach to acquisition is to pursue more of a software assets that are patentable, that can be then bundled in a broader IBM, both GBS and GTS operations. And then, last but not least, Xerox's acquisition strategy, the way we see it, is really enhancing and deepening what they do, their root of their strategies, like the BPO business and digital and the outsourcing portfolios, by adding analytics and automation and cloud capabilities. So different vendors have those strategies in a different level in the sense of what's important to them. But I think when we look back and see how they are, what the types of acquisitions they are pursuing, they are really following suit in the sense of like what the overall company's go-to-market strategies and where those acquisitions are filling the blanks for them. And what we want to, we were like, okay, so acquisitions are important, they're moving forward, but why? And in a sense, the Ramunas speed up in the beginning of what's been the transformation and disruption in the market in a sense of the advent of clouds and next generation technologies, and why are vendors acquiring? I mean, this is acquisitions, you know, the only mean of getting that scale and skill and IP. And we look at the different benchmarks here in TBR. I want to see how those markets are trending. And as you can see on the table on the slides in front of you, IT services, traditional legacy IT services, are for the 2Q15, they are $10.9 billion. And that's just a side note here, does not reflect the overall market size. It's the 30 companies that we track in the benchmark, and then the other respective benchmarks are covering certain sets of companies. But just to reflect on the size and then the growth or contraction in the sense of the IT services vendor benchmark. So we see the legacy IT services market revenues overall contracting, but then we see cloud professional services, business intelligence, digital marketing services as new landscapes, as new areas of growth where those vendors need those skills. And you can see those are more of a hyper-growth mode, essentially in a sense of like from 19 to 33+% growth for those benchmarks. And that's a kind of reflection of what why those vendors need the skills and why they cannot find them from somebody who is like fresh out of college or somebody just in a free market to recruit talent. So acquisitions are providing the opportunity. Certain vendors, as we pointed out earlier, are hiring at bulk. That allows them to kind of filter through a large number of candidates and get the best of breed talent that can address those new landscapes in the sense of the BI or cloud professional services or digital marketing services. So, but at the same time, we just remain cautious. The IT services still remain the largest pool and the largest revenue size. So therefore, vendors still need to maintain certain low-cost resources with that skills to support existing engagements to be able to, while they're ramping up new engagements with the new technologies and delivering new services, they have to maintain certain pools of resources that can provide those services. And we wanted to kind of, that was kind of the hypothesis around and kind of looking at what we look at the market, but then we're like, you know what, let's see what customers are saying and kind of get into, okay, our research, the customer research in those three areas that I just talked about was kind of reflective of what we just saw on the vendor side. So if you look at that's excerpts of buyers' expectations across the digital marketing services, the BI analytics, customer research, and cloud professional services customer research. I wanted to see what are the vendors expecting. If they invest in those new technologies, in a sense of how fast they're expecting the return on the investments. And across the board, I mean, the expectations in budgets, increasing in budgets in those three new landscapes, we saw that more than 60% of the respondents expect to increase those investments. But they're also expecting about close to 50% of the same respondents expect to get a fast return on investments. It's within a year. So that is a really quick turnaround in correlation of we're going to spend more, but are you able to deliver at the speed that we want to invest in the way we increase our budget. So those are the skill shortages, the gaps in skills internally on the customer side. They're going to the vendor like, okay, vendors, are you able to deliver what you are promising? So vendors realize that. So that's another reason that we're like, you know what? It's not just what we see in the market. That's how customers are responding to the demands. We need to acquire skills, and that's kind of one of the means to get into as fast as possible so we can address customers' demand for a faster ROI.
So effectively, acquisition is the fastest route to get the skill sets that you need in the marketplace. Certainly you can go organically and develop those skills, and some firms are working on that. Other firms are reskilling their organizations. Others are just hiring new people. And, you know, additionally, the other route is stealing people from each other, which we are seeing a prevalence in the marketplace right now. And it has having an impact on headcount. So the next question then becomes, well, who's making money? You know, that's really the whole kit and caboodle in a nutshell. I mean, are you making money as part of what you're doing or not? So the next slide, we actually looks at leveraging low-cost resources and/or, you know, is it having a positive or negative impact on profitability? The slide, you know, we've presented a number of different times, and it changes a little bit every time. Not surprisingly, those firms that leverage, you know, low-cost resources the most, the firms on the right-hand side of the slide, are turning in the highest profit margins. They leverage as well north of 70%. Then the rest of the market really is centered pretty much around the 50% range. And there's a few exceptions here, and those firms are trying to make changes and so forth. We look at the firms individually, we've noticed that, you know, HP has actually seen some margin improvement. That's, you know, occurring because, one, and we know very much, and we've seen it from the other results, that, you know, some of their revenues have been falling, they've been unloading unprofitable businesses, but they've been really reducing their headcount, and that certainly has improved the utilization and improved profitability for the engagements that they're still working on. Conversely, IBM has, you know, is not yet changing. IBM has a much larger, you know, fixed infrastructure and a fixed cost structure, And they're really chasing skills and still expanding and trying to build and add new capabilities on an ongoing basis. Reskilling certainly is a key element here, but at the same token, they're not yet realizing the profit gains that can be incurred from improving their own global delivery network. I didn't mention Capgemini in the earlier slide, but Capgemini, if you notice, their actual hiring has slowed a little bit, but they made a huge push back in 2014 to reconfigure their global delivery network and get them into the 50+% range in terms of delivery services and where they're being delivered from. And this has created a positive impact on Capgemini in terms of improving their profitability. And then finally, the other firm that I'm highlighting here is Infosys. And we know that Infosys is definitely pushing, hiring more people, trying to look at how to adapt to the marketplace. They have one of the highest low-cost leverage figures in the industry. But what's been happening for Infosys is that they're basically recognizing that there's a lot of stealing of people around, have been providing wage hikes. They're also expanding in nearshore locations, which is more expensive than expanding in India, and that is really impacting Infosys' cost of services and has had an impact on their cost of services, and therefore has reduced their profitability slightly. So what's the impact on operating income? And I'll let Boz get into that area.
Sure. I mean, we want to kind of take a look at kind of level deeper what Ramunas was just discussing, in the sense of like, how is it changing, and all these strategies, how are they impacting in the operating income per employee, in a sense of like, are those employees that we currently have, are they delivering the value that we're expecting? Is the upskilling, reskilling, divesting, any of the above strategies are really working, and how on the bottom line, and looking at individual levels. So on the graph here, we really look at the change in operating income per employee. And some of the vendors that we have highlighted, and Ramunas brought up HP's reorganization and idea of like getting a little more of an agile go-to-market, essentially, is the change in operating income. The positive change in operating income per employee for HP was again driven by the reduced headcount and the low-value account runoff, and the company started relying more on automation and agreed to lower the expenses. And also that kind of translates over to the total cost of ownership, especially when it comes to bidding for engagements. Atos, it's a company that's in a transformation stage, but it's also able to pair low-cost leverage with some cost-saving programs that company has implemented along the way, and also consolidation of facilities and higher value solutions are helping the company to see a positive impact on the operating income change in operating income per employee. We brought up Infosys in a sense of what the company is doing, and they saw a lot of transformations, especially on the top, around the executives. The company has started beginning to show some signs of improvement, in the sense of like, we made all these bets, we changed leadership, and made some bets around acquiring automation IP with the acquisition of Panaya and Scavo in the first half of the year of 2015. There's some proprietary IP investments that the company has done, and that has had some positive impacts overall in the operating income per employee. And it's what it was about a year ago, when the company was really more of a kind of a chaotic stage in a sense, because of the turnover over 20% and exodus, in the top of the pyramid. So the company has started seeing some positive results, as reflected here on the screen. One company we didn't circle around, but on the India-centric vendors is Cognizant, and you see the change in the income per employee, operating income per employee. is significant. And you see 10% down, you think about, well, Cognizant has been more of a ahead of the stack of the India-centric vendors in a sense of, investing in higher value services, getting more of a client face time and capturing some market share from some of the global MNC competitors. Why is the change in operating income per employee contracting 10%? What we saw is despite our ongoing shift towards automated services and cloud-based projects, the company continues to hire, and that's the accelerated pace of hiring. They also acquisition costs, expenses that they had to bear over the last year, and some wage hikes to retain that talent. I mean, that the one that is able to deliver those services. So they have experienced some growing pains in the sense of climbing up the value chain, and that kind of impacted a change in operating income per employee. And as kind of the headline pointed out, there is a lot going on in the market in a sense of investment initiatives, automation, reskilling employees. But only 6 of the 14 vendors have been able to benefit, at least in the 1H15, at least what we saw from all these investments, to capture and capitalize essentially on those investments.
I wanted to also add, especially since you brought up Cognizant, that, I mean, they've been one of the firms that have historically been willing to invest back in their business.
Yep.
So they're not chasing the profit dollar as aggressively as some of the other Indian firms. So that certainly also, explains partially how their numbers are popping out in terms of they are continuing to hire and trying to make sure they stay ahead of the game, stay in the same profitability range, but not necessarily, be the leader in profit generation.
Yep. Yep. And if we look at the next slide, essentially, I mean, we want to kind of see what are the other variables and efficiency metrics that are impacting profitability, and it's really getting to attrition. We kind of already touched base on employees turnover, churn, poaching, hiring, acquiring. Those are different venues that vendors pursue, and we can see across the board, on average, with a couple of exceptions, attrition went up across most of the vendors within the benchmark. And so we're not surprised because it's kind of like it's a good summary of what we just spoke about over the last half an hour or so, and how vendors are trying to sustain and retain their talent. And we have highlighted some of the vendor strategies, even though it's the attrition went up. What are some of the ways of they're trying to retain, or why they're actually losing talent? So, for example, we just spoke about Cognizant. They are promoting a completely Cognizant employee engagement program. They're facilitating reskilling their staff around digital technologies, developing a digital-verse workforce, essentially, and provide career roadmaps to encourage the high performance to stay with the company. Again, it is a challenge, but there's some tools and there's some programs that have started to implement and to retain this talent, because they're realizing, hey, there's a war for talent, and how do we keep those guys? We see Accenture attrition spiking up, and I mean, Accenture is one of the examples that we brought up earlier, a sense of a company that's hiring in bulk. I mean, we see the company last fiscal year, hired over 100,000 gross employees. But when we look at the net, it was about 35–38% of what the actual net was, and that kind of raised the question: why are they doing that? Well, one fault will be to look at, well, they need to kind of filter through training programs and get that employee base, the one, the best of breed that can deliver those new technologies. But we also see that it has some impact in kind of creating some unstable environment that we believe is impacting the attrition and some of the living of the attritions going up for Accenture. For Infosys, it was a company I brought up. It's been going transformation. The company starts to reevaluate the reporting format. There's certainly some of the new initiatives have seen a positive impact. It launched a crowdsourcing initiative where start collecting the employees' ideas and begin to implement them, and giving that sense of empowerment to the employees, getting to be like, hey, we want to do something good. The new leadership has those new ideas, to have the forward-looking vision rather than the backward-looking that they try to go back in the mid-2013 to mid-2014 before Sika came on board. So they're certainly seeing some positive impact. And TCS is another one that we just highlight here on the board. Is they invest in a very expansive employee bonus program, advanced communication network that's GNOME, and really some new initiatives, recruiting initiatives that get selected degree programs that can try to tailor to what the company's current developments are, what the market's expectations are. So again, we see those in place. Vendors are certainly not, they are being as proactive as possible, but again, there's certain other outside market forces that are disrupting, and clients' preparation expectations for a faster return, as we spoke earlier, in those new technologies is what's kind of creating some of those hiccups along the way internally in some of the efficiency metrics.
Yeah, the one company we didn't mention on this chart is HCL, and you know, when you think about it, it almost seems like the impact by Infosys and Wipro is mimicking what HCL has done historically with their Employee First program, where they've always been, you know, looking at their employees and trying to make sure that their employees have a voice in the company, are participating actively, are not just cogs in a big machine. And it's quite possible that more and more firms are going to move in that direction, given all the red arrows pointing up. Everybody's got to make changes in how they deal with their employees in terms of trying to minimize attrition, because it's expensive to lose an employee that you've trained and hired and, you know, worked with and has developed a certain skill set, and suddenly have them stolen away. So with that, you know, where do we stand? What's happening, you know, from an overall perspective? Headcount growth continues to go up. When you look at the numbers and you pull out the oddities or the things that are really destroying the overall picture, it's keeping pace with revenue growth. The composition of people, however, is changing, and there's a definite need for skills, and many firms are now moving in through the acquisition routes to accomplish and gain those skills. The acquisitions themselves, most are small, niche acquisitions, targeting a specific area where they need some additional skills, where they don't feel they can develop them quickly enough internally or hire them, although some firms are very aggressively hiring laterals, which is then impacting your attrition numbers. And finally, I mean, profitability. While global delivery certainly has an impact on profitability, it's not the sole component. There's a lot of other financial factors and moves by the firms. Much of it also depends on their portfolio and how quickly it's adjusting to the new emerging technologies, and whether or not they can deliver on those technologies and therefore get the profit dollars available in the marketplace. So with that, we're going to open up the lines for questions. Please provide the questions through our Q&A function, and we'll answer them as they come in.
All right, so the first question we have, gentlemen, is how much of Accenture's attrition is driven by their acquisition of Cloud Sherpa and others? So they acquired Cloud Sherpas. Do you think that drove a lot of attrition on their part?
I think it's not just Cloud Sherpa or any of the other, it's a combination. I mean, the attrition, as I brought up earlier, I think for Accenture, first of all, we don't have a particular number to say that the attrition X is correlated to X amount of acquisition or number of people that were brought up. Those moving forces and those driving forces that Accenture is pursuing is certainly impacting, as was brought up, hiring collaterals in bulk versus acquiring, and also existing employees being poached from the competitors. So you have so many pieces, essentially, that are internal and external that are driving. So we don't have a direct correlation, per se, in the sense of like the number, but there are certainly forces that are impacting. But look it up, you know, if you look back to the attrition number, go back, please, just to the slide, overall, the average. So if you look at the average is about a little bit over 15%, and Accenture's attrition is slightly below the average. It's not that impactful, let me say that way. Look at across the market as a whole.
That's not to preclude that anytime you have an acquisition, people are going to leave.
Right.
But we don't believe that's the key driver here behind the situation. Be it whether it was an acquisition or not, it's just the overall trend from a corporate standpoint. Because again, as a percentage of their total headcount, Cloud Sherpas was less than 0.1% if I recall correctly, in terms of the number of people they actually gained. So in terms of influencing the actual number, it's pretty small. On the other hand of the equation, many firms very carefully, when they do make acquisitions, make sure that the culture and the people that, and especially if it is a people acquisition, are a match, so they do not incur that kind of scenario of losing a lot of people. I mean, that's almost a prerequisite. If you, acquire a firm and everybody leaves, then you've acquired a shell. And it's like, uh-oh, we didn't do a very good job here in terms of picking the firms we want to acquire. So it has a very insignificant situation in terms of actually impacting the actual overall numbers.
Okay. Next question is coming on Infosys, and this question is, have you seen any specific shifts in employee morale at Infosys as they execute retention plans and start to turn their business around? Yeah, that's a loaded question.
Yeah, it's a loaded question. Well, I guess it's a two-part answer too. I mean, in the sense of what's being promoted on a public domain versus the reality internally. So, the way we see it, what the Infosys likes to be perceived as right now, the way we see it at least, is that things are getting a little bit better for what they were a year ago. Are they as good as what the overall market is? Probably not, but they start making the changes. But if you to talk to employees and make more of an internal survey, I think that we may find some different answers in a sense of like really the reality check of what's really happening. A prime example, and I'm not sure, I don't know if there's any what's the significant level of correlation of like the CFO just departed right at the 3Q earnings, 3Q15 earnings. So it's kind of a sign, kind of indicator where, yeah, there's good things happening, but maybe they're not happening as fast as they need to be, and maybe not all the pieces are in the puzzle are put together in place yet for everybody, because we still see attrition. I mean, it gets been stabilized, but there's certain ongoing churn and getting to filter through some of the older employees with older mindset, I guess, with more of the nuance and getting to deliver those newer services.
And Infosys has been going through change after change after,
Yeah,
they've been rotating through.
It is a lot of rotation, a lot of rotation, and in a sense, again, it's external view, external perception versus internal reality. That's, I think it might be actually an opposite side of the spectrum of reality.
So the next question, how's Cognizant and TriZetto's integration going on? Was the high attrition caused from the TriZetto acquisition? Let's go back. I'll find the slide. You guys start hitting that.
Whenever you acquire a firm that's heavily in the outsourcing business, and TriZetto with their healthcare industry, certainly providing healthcare services from that perspective, and it's predominantly in the BPO space, you're going to have an attrition impact. They gained a very large business. It's going to push their attrition numbers up. That's true, and it's kind of true also a little bit for all the firms that are heavily involved in the BPO practice. Their attrition rates typically are at a higher level than many of the other firms, and it's a consequence of the nature of the business. You're using lower-level skilled employees. They turn over much higher, much more quickly. So it certainly had an influence. Again, we haven't monitored the exact percentage or amount of the impact from that standpoint, but it certainly has had an impact from that, in terms of occurring in their business and with the acquisition.
I think another part of that too, we have our healthcare IT services benchmark coming out later this month or next month?
The webinar Thursday, no?
Webinar's Thursday? Yeah. Oh, from the last month.
From the last month.
Okay.
The next
so on Thursday, they're probably 1 o'clock, same time, TBR's Healthcare IT Services benchmark webinar will, without doubt, go into Cognizant or TriZetto. So recommend listening to that as well. It will probably give you maybe a more detailed answer on that particular question. Another question has come in regarding shifts up and down with attrition. Are there averages? How long the trends normally last one way or the other? So this is kind of like a going back over the last however many benchmarks have we seen this. What do you think?
That and also IT services benchmark as a whole, to kind of the way we traced, it's a broader benchmark. It's 30 vendors, as we highlighted earlier. A look at which gives a little better, it expands the addressable market in the sense of like what we look at 14 vendors out of the 30 and what averages are, how they're trending, and if we want to go pre-recession, post-recession times, etc., you know, kind of like when the cloud market starts to mature, emerged, and then start to mature, how that has impacted. So if we start like drawing down the timelines, that could give us a bit of a better sense of like, and correlate that back to attrition and start finding some averages.
We haven't run the trends from a long-term perspective. I mean, some of the influences on the trends, yes, there's some bounce for some of the firms. It's notorious when there are huge pay increases or as a result of inflation and so forth, you know, when the pay increases come in, or if there are bonuses associated with it, people hold off and then leave. So there are all these influences, but it's a mishmash from that perspective, so it's sometimes very difficult. The trend we're seeing right now is that, you know, attrition is up. I mean, and we see it not just at the, you know, the overall general population, but when we review, especially in our IT services vendor reports, just the turnover at the upper echelons of organizations. We're seeing a lot of people from one organization shifting over to another, going to a third. Those are every one of those moves is, in fact, an attrition from somebody else. So we're seeing that very vividly in our IT services vendor reports in terms of monitoring how many executives, leaders of various groups, regional leaders are shifting, changing, coming from one company to another. So the overall trend, we're pretty confident this is reflecting very, very clearly the market, and not just at the bottom level of just people are delivering, but across the whole organization.
So, and then to sort of go a little further on the question, how long have we been doing the global delivery benchmark? Could we go back a couple of years and construct, because this is to Q14 to Q15. Can we go back to Q12?
Yeah.
We have
the data,
So we can pull that together. So
we may actually include it in the next webinar.
Yeah, maybe the next time we go around on this, or the person who asked the question, if they want to reach out directly, we can pull something together. Something that we could definitely do. Another question came in. Justin, if you want to go to slide 10, the percentage of headcount from acquisitions you highlighted earlier. So this would be the slide that we highlighted that on. Excluded Capgemini and Atos' acquisitions of iGate and Xerox ITO. Do you know what would the percentage look like if you added these, and are any of the acquisition-averse firms departing from their status quo?
I mean, yes, I think I was talking on that slide earlier. I think when we look at the data that I pointed earlier, we didn't include those two acquisitions for Capgemini and Atos because they were effective essentially in 3Q. But we run the numbers kind of backwards just to kind of the broader perspective. And both companies, in terms of the headcount from M&As, was north of 23% as a percentage of total headcount. Atos already had some jump start essentially from the acquisition of Bull about a year ago, and that gives them to the 11.5%. That's a big boost. Then Xerox ITO added another 12+%, where Capgemini's iGate acquisition certainly catapulted from 1.3 to over 23% essentially, in the sense of where their headcounts would look like from acquisition. So the core of the headcount essentially for Capgemini would come from acquisition, and that essentially it's a big boost. And I think Ramunas was talking earlier about Capgemini, what they've been doing, how aggressive they've been over the last year, and bringing up that low cost leverage a little more on the kind of sweet spot, and making that ratio of 60-40, close to that ratio of 60% of low-cost locations versus 40%, onshore locations, to be able to managing on-site clients' expectations, but also have a low-cost profit lever that can allow them to compete on a pricing engagement when it comes to the pricing as a level. Was the second part of that question, what was it?
So it was are any of the acquisition-averse firms departing from their status quo?
That's an interesting question. We keep tracking on that. Then we know some of the vendors have been a little bit more aggressive with the acquisition approach. Like I think Accenture announced about 40 to 50 acquisitions in the last 3 years, and IBM is someone that constantly goes through acquisitions. But a company that has been really acquisition averse has been HCL, and as you can see on that slide here, it's 0%. There was no inorganic headcount essentially since 2013 through 1H15. However, over the last 4 months, since July, HCL kind of departed from that status quo and essentially pursued 4 acquisitions since July. So 3 in October and 1 in July in core areas like engineering services and R&D. They acquired some assets of TriStack Technical Services and Concepts to Silicon Systems, and they also expanded their ITO capabilities with external IT services from Volvo Group, which added about 2,600 people on ITO division, and application outsourcing vendor whose name Power Object, which added about 250 people as well. So they're certainly those vendors have identified, like HCL, see, well, everybody's doing it. We've been good to do what we've been doing without acquiring, but I guess it's time for us to pull the trigger on some of those as well.
They got to come on board.
Yep.
All right. We have one more question we can get to, and it's a real straightforward one, I think, probably with a long answer, though. And the question is, are vendors hiring onshore to address offshore delivery issues? Do we have a good answer to that?
I think you spoke earlier about it in terms of Ramunas spoke about pricing points and how vendors are hiring and why they're doing it, and kind of when vendors are going to the clients, like you can compete on a price point to deliver from onshore. You can compete on, we can deliver services from nearshore location that's going to cost you Y, and we can deliver services from offshore location that's going to cost you, it has different price points. So each of those on-site, nearshore, offshore allows vendors to offer different price points for the customer. Customer essentially have to decide what goes best for them and to decide, am I ready to take the risk, everything to be run offshore? Do I go blended? Do I just go everything? Do I demand completely on-site because I need to be in control with how the engagements will run? I mean, we know that India-centric vendors have been the one that have been as most aggressive to expand onshore and nearshore hubs to be able to not just compete from a low-cost perspective, but also to have 2 extra options for the clients into on-site and nearshore hubs expanding in those locations.
Yeah, the other half of the equation, though, and it doesn't necessarily influence numbers as significantly, is that the relationship building that's going on, firms, with the changes in the emerging technologies, consultative help, really partnering with your customer is becoming more and more critical, which means that, long-distance partnerships don't work real well in society in general and in business as well. So to build those relationships and improve them, we're seeing that, firms are opening up more local sales offices, which are, they're still not necessarily delivery centers per se, but they're relationship centers. And they're trying to establish themselves that way as well. And it is expensive, certainly, to do so, but you can improve the relationship, improve the partnership you have with your customer. That also has a positive impact because then you can leverage your offshore resources to deliver and make up the difference from that perspective. So it's a multi-pronged approach, and it's impacting total headcount in multiple different ways and in different portions of organizations.
I think that's it. Justin, you want to finish this up?
Yeah.
No, one more question. Just slipped in the door.
Actually,
So, yes, the question is, we'll be able to, excuse me, be able to get a copy of today's materials. I will be following up with all of you tomorrow afternoon via email with the recording link for today's, with the link for today's recording, as well as with the slides. So if you don't get that, please reach out to one of us. But yes, other than that, I'd like to thank Ramunas and Boz for your presentation today, and thank you, Patrick, for your help with the Q&A session. So you can follow our analysts on Twitter on the handles listed here, and please check out our pages on SlideShare and YouTube to view our previously aired webinars. Additionally, before you sign off, I'd like to ask you to take a brief survey on the webinar today. We do read all those comments and are always looking to improve both our webinars and how we present them and what we present. So your feedback would be greatly appreciated. We'll leave the chat function open for another minute or so for people to send in any last-minute questions. Otherwise, thanks for attending, and have a great afternoon.